Hi, I'm Aaron Newworth with ETF Trends and ETF Database. I'm joined by Mark Carlson, Senior Investment Strategist at FlexShares Exchange Traded Funds. Mark, how are you doing?
Good, Aaron. Good to see you again.
Yeah. Mark, I'm going to ask you for your thoughts on three topics as we head into the dog days of summer and early fall. First, looking at the COVID Delta variant's impact on consumer and business behaviors, what happened and what's your outlook?
Well, the Delta variant has impacted the Pacific Asia areas the hardest, with major production areas like Australia, New Zealand, Japan, Vietnam, and China implementing various shutdowns on either commercial activity or transportation. And here in the U.S., I think most dramatically, we saw a cutback in travel. We saw airlines with increased ticket cancellations and a reduced travel demand as COVID cases ticked higher. As a result, we saw a pullback in economic recovery in those recovery sectors and in the commodity markets. As you know, the market sought to assess the extent of the damage that has been done to demand and the short-term and long-term impacts on supply. Now, if we follow the pattern of the rest of the world that has already had a Delta variant, say like India and the UK, which both saw spikes earlier in the year, we should or could be seeing the Delta variant cases peak here in the US and then begin coming down. So it will be viewed as a temporary type of impact on supply and demand and economic activity. And this is all positive, but this is something I think investors and markets need to get used to, is that COVID is not going to be going away anytime soon. We will be more than likely going through cycles like this where we will have spikes in cases and there will be reactions to shut down economic activity, not like what we saw in 2020, but some curtailment, and the investors need to be ready and positioned accordingly.
Mm-hmm. Well, moving on, for the Federal Reserve Jackson Hole Conference, will any talk of curtailing purchases of treasuries and MBS from the Fed cause a taper tantrum?
Well, that's the goal of Chair Powell and the other speakers, will be to really to assure the markets that they are considering tapering asset purchases in an orderly and timely fashion, but possibly giving guidance to the fact that any adaptation of a tapering event will be modified if need to if and when the environment worsens during the event. So any guidance there would be helpful. It will be interesting to see, though, if they attempt to break any linkages that are currently in the market between when there might be an increase in the overnight Fed funds market, which right now is pricing in a 50% chance of a rate hike in late 2022. This would be a little quick versus the previous taper that we had in 2013, 2014, when we had rates being hiked then in December of 2015. The market in our opinion, would seem to be a little bit early with our outlook for an overnight rate hike, given the rhetoric coming from the Fed, even if they elect to go with the taper. So really, coming out of the Jackson Hole meeting, the risk is really only to the downside. There's little that they can provide in terms of uplift to the marketplace. And so we're hoping that the markets take Chair Powell's statements at face value, don't read too much behind the lines or between the lines, and await the September FOMC meeting for the actual terms of any tapering action.
So oil, iron ore, and other commodities have retraced some of their 2021 price performance. What's driving this swing, and what should investors be looking for as we head into the fall?
Well, the Delta variant caused this, actual and anticipated declines in demand, especially in energy, where, any negative news right now is automatically tied to decreased travel, which sinks prices on oil as it relates to either gasoline or, say, jet fuel for current or future consumption. So that's really the most sensitive area. Iron ore was impacted by Chinese regulatory actions, where they were moving to lower greenhouse gas emissions being produced by their steel industry, and so that actually caused a drop in iron ore prices, because of the fact that the offtake from iron ore mines would be lowered by the biggest consumer of steel in the country. Now there is belief in the marketplace that the Chinese authorities will manage the slowdown in steel production to a level that will not be recessionary and still protect their overall economy by this very important sector. I think one of the most interesting sectors we've seen in 2021 has been lumber. We've seen dramatic price swings going up to record high prices in May, which gave way after increased supplies and then a drop in demand due to pricing. The 2020-21 lumber environment is a perfect example of when you have robust demand meets a supply bottleneck to drive short-term price performance. Now, we at FlexShares and Northern Trust Asset Management remain constructive on natural resources despite the short-term impacts of higher COVID cases. We believe pent-up demand, supply bottlenecks, and ample fiscal stimulus should continue to support natural resource prices. And we firmly believe that investors should use these last days of summer to review their investment objectives and positionings and be prepared for market volatility as we move into the potential tapering territory, along with perhaps some of the most significant fiscal policy changes of the last 30 years.
Well, once again, thank you, Mark. We appreciate your insights as always and look forward to chatting again soon.
Thanks, Aaron.